In this video, I will analyze one of my subscribers' portfolio, one of you guys, because on eToro a few days ago, I posted this. If you want me to analyze your portfolio, please comment to this post. And we are here, Uladimir Pensi, that said yes. So yeah, obviously we will check, and we don't know what is inside the portfolio. So it's like a mystery box here. Let me click on the portfolio so you will have a better view of what is inside. What do we have? Basic Fit, AHS Holding, Alibaba, Evolution, JD.com, China National Building Material, and China Evergrande. Oh wow, that's a concentrated portfolio with a strong allocation to China. Okay, and zero cash here. Everything is invested, so that will be fun. We will see if these businesses are good or not, and you will have my opinion, what I think about these picks, obviously. So in case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in great stocks. So let's see if we can have great stocks over there. Okay, well, let's start from the beginning. You have your biggest position, Basic Fit, that's 30% of your portfolio. Wow. Basic Fit, let me check on Google Focus. I know the company, I know their what they sell, but I don't know the business actually. I've seen this business because, I mean, when we worked in a European investment fund, I saw the ticker, I saw the company, but I never did a deep dive on the company. Okay. Is it a big company, small company, from which country? From the Netherlands. It's a market cap of $1 billion, $2 billion. And in case you don't know what Basic Fit does, they operate fitness clubs. That's the end of the business model. So you have a recurring revenue from the membership, and you have payment options, etc. They are in Europe mostly. Oh, so not in the US, not in Australia. Okay, so Netherlands, Belgium, Luxembourg, France, Spain, and Germany. And if I look at the past growth of the company in terms of revenue, you see some good signs. Good things. They suffered in 2020. Well, people did some workout at home, but now it seems like they are rebounding sharply. Is it a profitable business? Not at all. It's a quick pass for me. That was the end of the analysis. Oh wow, that's a lot of losses for 2020, 2021, and absolutely no rebound for 2022, 2023. They have a sustainable amount of debt, but before I dismiss the investment idea, I want to check several things. First, I will go to the annual report to see what are the costs of the business, because this is quite intriguing. I mean, this should be a recurring business model that generates some money. And for the debt, I have a doubt, because I don't think this is normal debt. I think you have some flooring plan, leasing, that can be a different kind of debt. And what about the operating cash flow? Operating cash flow is rebounding strongly, like revenue. And what about the free cash flow? Strangely enough, the free cash flow is positive. So if you compare the net income, well, the losses instead of net income, I should say losses, to the free cash flow, you have a different picture. And you have some dilutions of shareholders during COVID. Quite intriguing, actually. Quite intriguing. Let me check on FinChat what I can have. 30% of your portfolio is in this one, Basic Fit. That's I mean, that's not my go-to kind of investment ideas. What do I want to check? Maybe the financials. Can I check the cost structure of it? So the revenue, this is the COGS. Revenue is $1 billion. The COGS are $200 million. So they have a 80% gross margin. Is it correct? Is it good? Oh, we don't see anything on Google Focus. Okay. And the gross profit margin is roughly 80%, which is pretty good. Selling and general expense, depreciation is here. Oh, that's huge. Operating expenses, that's huge. Other operating expenses, that's huge. So if you look at the operating margin, here we are. That's a complete mess. You have some interest on the debt, and that gives you a very bad, very, very bad net income. Okay, let me go to, maybe I want to go to the investor relation report. I want to check what is the cost structure. Normally you can see this is the geographical split. I want to check a basic income statement from a quarter, from an annual report. Anything that can be useful. KPIs, no. Come on. Basic fit. Annual report. Annual reports. I don't think I will spend too much time on this because I don't think most of my viewers are interested in this one. But just for the sake of the exercise, income statement. Net income. What do we have? No. Oh, I should have gone to the beginning of the document. Let me check. Management board report, business and financial review, consolidated financial statements. If I click here, come on, comprehensive income. Is it this one? Yes. Okay, what do we have? This is the revenue for 2023. Cost of consumable used. Okay. Employees benefit expenses. Benefit expenses, that may be the salaries. Depreciation, amortization, that's huge. Operating expenses. I want to check what is this big cost. 3.8. Oh, that's clickable. Wonderful. Other operating expenses. What is very expensive? What is big in this? Housing expenses. What is housing expenses? What do you mean housing expenses? Net marketing expenses. If I put housing expenses, what do I have? Housing expenses also increase significantly due to higher energy costs and marketing expenses. Oh, no, just higher energy costs. So most of the costs are salaries, energy, electricity, depreciation, amortization, and marketing. And the business has been here for maybe a decade and is still not profitable. So we are in an aggressive business model. And the second thing I would like to check is the debt. Other operating expenses. Let me go back to the income statement. Where is the income statement? No. Come on. Here. And I want to go to the balance sheet. So we said that they had what, more than $2 billion of debt, or dollars or euros or whatever. And this is this one. Borrowings is debt and leases liabilities. Okay. So they don't have, I mean, if you check on Google Focus, quick tip for you. If you check here on Google Focus, they have $2.5 billion of debt. It's not really that. It's $1 billion of debt. Long-term debt. Here you don't have, you have a small tiny short-term debt. Most of the debt is long-term, and most of the remaining liability is the lease liabilities. So if you click on this one, you will have more information. So okay, not real debt. Right of use assets. Okay, very well. Perfect. Okay, so 1 billion, like $800 million of debt compared to this market cap. Quite a lot actually. And if you compare this to the free cash flow they generate $100 million of free cash flow. I mean, that's a lot. That's still a lot. If I look at the free cash flow position of the company, what do I have? No, it is not here. Equity. Cash flow statements. Here we are. Profit and losses. I mean, this is terrible. You add back the DNA. They had some COVID-19 rent credits. Very well, adjustments. What is that? Adjustments for finance costs. What is that? They have a lot of capex. Like a lot of capex. I don't think the cash flow from operation is that good actually, and still they have a lot of capex. Like proceeds from borrowing. Yeah, they took more debt, they repay some of the leases, they took more debt, they pay the interest, and the free cash flow is bad. Oh, wow, okay. So I think they are basically cheating. I mean, if you add back the DNA and that you have the adjustments for finance cost. I would be wary of this. What is the adjustment for finance cost? I mean, this is a good question for you. Maybe you want to check this. Or maybe you want to check if they are cheating and delivering fake free cash flow for you. Because if you generate a fake cash flow from operations, you can generate a fake free cash flow. But yeah, very interesting. Not for me, by the way. Not for me. The net income is bad. Net income is really bad. The free cash flow seems to be inflated by all the adjustments. You add back the DNA, but either way, the business is not that good. And frankly, I don't go to the gym. So, I mean, not that often, so I don't have a membership. It's a little bit out of my circle of competence. It's a simple business model, but not really my style. I want businesses to be profitable, recurring, high margins, and generating a lot of free cash flow. So definitely not my cup of tea, but I see why you are invested in this one. Another question that I would love to know on your end is why is it 30% of your portfolio? Why is it 30% of your portfolio? I mean, come on. What is the base case on this one? The business just starts to generate free cash flow just for the past 2 years. Before that, it was a complete mess. And yeah, okay. In terms of valuation, well, if you don't have any earnings, you don't have any PE ratio. If I go to the estimates from Wall Street, I mean, what is Wall Street expecting from this business? You can check. Everybody is expecting some double-digit growth. Seems like people are expecting to ramp up profitability. Maybe I want to check what is the company's plan to become profitable. Maybe in the future, like in the next 5 years, the company has some great plans to turn up profitability. So let's see. Let's see their latest investor presentation. They talk about them clubs, membership revenue. Well, from the first slide, we see no signs of profitability. Outlook 2024 maintained. Oh, that was the Q3 2024 from October 2024. Okay. Further strong membership base, blah, blah, blah. No. Underlying EBITDA less rent. Yeah, I mean, you are cheating. Free cash flow before new club expansion per share. What is this metric? Free cash flow before new club expansion per share. Come on. Free cash flow before we invest the cash. Free cash flow before costs. Free cash flow before all the costs. Update on franchise opportunity. In a franchise model, we can leverage. Okay, well, they talk about what they have. Potential. Oh, come on. That's it. Oh, that's it. Okay, let me check another slides. And oh, this has more color on the profitability. Let me check again. Let me growth. Clubs. Cost. Expansion. We want more expansion. We are everywhere. We open new clubs, etc. Okay. I don't know if this is a luxury or basic, middle class. I mean, people my age go to Basic Fit, so I don't think this is high-end luxury. I mean, I'm young, so I don't think this is a kind of a private model. I don't think the costs are that expensive. You pay maybe $20 per month, $30 per month to go over there. So I think it's for everybody. It's for the working class, middle class. It's not... Okay. So I don't think the cost structure will improve that much. Okay, club opening pipeline. I mean, everything is focused on growth. Is that it? Major club development, capex. No, club. I see no sign of profitability in the future. So to that regards, I don't think the margins will go up. And when it comes to the debt, they have to repay their debt in 2026, 2028. Okay. So in 2025, I think they will take advantage of the debt to continue to invest. Well, not convinced at all about the profitability, to be honest. They show no plan of being profitable. Maybe you will have some economies of scale and fixed costs. But no, the costs are not fixed. The salaries will go up because you will hire more people because of more expansion. So salaries, SG&A will increase proportionally to the growth. Electricity, energy cost will go up proportionally to the growth. the D&A, depreciation amortization, will go up proportionally to the growth. So you don't have any fixed costs, like not a lot. And you have, I don't believe the numbers. Strangely enough, maybe I'm wrong on this one, but I don't see the profitability improving massively from there. If I go to the cost of goods sold and the margins for the past 10 years, look at this. This is the gross margin. Gross margins were at 10%. Operating margins were a mess. I mean, I don't buy the numbers at all. Either I'm missing something big. The comment sections are here for this reason. If I'm missing something big, please comment below. Or I don't believe the numbers at all. From the earnings per share from Wall Street, they expect to double their earnings every year. No. From the EBIT, what is Wall Street expecting? 30% growth, 40% growth. I don't believe them. And the free cash flow? Oh, free cash flow is more messy for the future. For the CapEx, they plan to continue the CapEx. Yeah, okay. Not frankly convinced, but okay, why not? Why not? Not particularly liking this first pick you have. And when it comes to the valuation, let me check. What was the trailing free cash flow on this one? Trailing free cash flow, let's check if we can kind of put a multiple on this one. They generate 150 million of free cash flow. Can I check the latest data? Financials, cash flow statement, regardless of the debt structure. I just want to put a multiple on this one. Free cash flow. Oh, where is it? Free cash flow here. Free cash flow is last 12 months. You see here, bottom. Let's say $200 million. Let's be kind to this company. They have a market cap of $2 billion. That's a cheap free cash flow multiple on this one. And if you include the debt, that's a different story. I mean, if you generate, that's a price to free cash flow of 10, basically. So on a pure free cash flow basis, the company can be cheap. If you add back the debt, definitely not cheap for all the risks. But if you only look at the free cash flow, I mean, this is fine. This is fine. But you have to consider that free cash flow is volatile. Free cash flow growth is very recent. Before, the company has never generated any free cash flow. So I would be very cautious of this. If you look at this line, free cash flow, you can see that this is a very different story. Maybe you can have a reversion to the mean. So if you are still watching this video and you are interested in going deeper in basic fit, you can check what happened in 2016, what happened in 2017, because I suspect that here in 2018, the first year the company generated some good free cash flow. They should have had estimates, forecasts of the growth, and it didn't happen. I mean, you are biased because of the COVID, but I would love to know what is their plan to generate free cash flow, and if they fake the free cash flow or not, like cash flow from operations. But yeah, definitely an interesting pick. Not my style, but I can see the opportunity here. Good luck with 30% of your portfolio. That's a lot of conviction. That's a lot. I mean, if you are a client, if you know how it works. By the way, you are Polish. I'm in Poland right now, so I know how people are shredded. People love love the gym over there. So yeah, I mean, I've seen the basic fits here in Poland. Let's check the other one. IHS. Oops. IHS.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
What is that? Company from the UK? IHS Holding is an independent owner, operator, and developer of shared telecommunications infrastructure. The company provides telecommunications infrastructure to its customers, most of who are MNOs, who in turn provide wireless voice and data services to their end users. I have not understood anything. Its geographical segments are Nigeria, Sub-Saharan Africa, Middle East, North Africa, and Latin America. Most of the revenue are from Nigeria. Oh, that's interesting. That's a pick from Nigeria. That's awesome. That's amazing. We can even check on FinChat what they have to say. AHS. Let's check another description of the company, another summary, so that we really understand. Develops shared telecommunication, Africa, Latin America, lease equipment, build to suit, fiber connectivity, rural telephony solutions. Wow. The company IPO'd. The company went public in 2021. Oh, I don't think I will like what I see. Oh, okay. Revenue going up slightly every year. Net income, I mean, is horrible. What is the market cap on this one? $1 billion. And they generated 2 billion losses in 2023. I suppose they have some leases, so always take this with a pinch of salt, but seems like they have some debt, some leases, $4 billion. And what about the free cash flow? Free cash flow shows a different story. If you compare the net income and the free cash flow, definitely a different story. So maybe there is a financial accounting trick here. Free cash flow is $200 million. And they don't dilute shareholders, they don't do buybacks. Definitely a business that is way out of my circle of competence. Maybe I want to check some financials on Stock Unlock. I mean, if you want to navigate Stock Unlock and FinChat and Google Focus like I do, you have some discount codes in the description. You have some reduction in price, some discounts. But I like to navigate between these three websites. Okay, revenue goes nowhere. Cost of goods sold follows the revenue. Half of the revenue is in COGS. I don't know, but you have some fixed costs over there. SG&A is following. The margins are not that high for such a business. Net income has always been negative. That's a complete mess. They have some debt. They have some net interest expenses, so some debt. And what about the? Oh no, you know what? I will not go deep on this one. You have a lot of infrastructure. Look at this. Look at this line. Property, plant, equipment. You have a market cap of $1 billion, but you have property, plant, equipment of $3 billion. I mean, this is the asset heavy business. Does generate some cash. I don't like what I see at all. Other cash. What's that? Other non-cash items. What can I show you? Free cash flow is here. That's the free cash flow per quarter. Keep in mind, this is a company with a market cap of $1 billion. So sometimes they generate $200 million, sometimes only $30 million. Maybe I want to check the investor presentation, the slides, maybe in investor presentation, what they have to say. This is definitely an interesting story, but I want to check. Okay, what do we have here? This is the report, the investor presentation from Q3 2024. The revenue goes nowhere. The adjusted EBITDA and what is that? AL free cash flow. What is AL free cash flow? Recurring leverage. Adjusted leverage free cash flow. Oh yeah, come on, let's cheat on the numbers. Let's completely fake let's completely fake the numbers. No, come on. Let's be serious. No. What do we have? The tower portfolio. Yep, they are in a couple of countries in Africa. That's great. That's good. I mean, that's a great project. Highlights, strategic review, communication, Nigeria. I won't go into this. Our approach to sustainability. No, they build towers, tenants. Definitely out of my circle of competence. By far, all the numbers are adjusted. If all your numbers are adjusted, maybe it means that your true GAAP numbers are bad. Sometimes this is as simple. So if you look at the revenue growth year over year from Q3 2023 to Q4 2024, what do we have? CPI escalations, FX, this power is increasing, fiber and FX How can foreign exchange can be a plus and a minus to the revenue? Okay. Seems like Nigeria is your biggest market, growing the fastest. What is this foreign exchange and power exposure overview? Nigeria is definitely the biggest market. Most of the revenue is in local currency, so you have to be hedged, and this is a cost. Consolidated revenue and adjusted EBITDA. Come on, let's fake the numbers. Sorry, but I hate when people use adjusted EBITDA. Revenue growth is bad. Adjusted EBITDA has been stable year over year, and your adjusted EBITDA margin is 50%. Adjusted leverage, come on. Every slide I want to get out of this investor presentation. Tenants, debt profile. So they have some debt, very well, and the debt will have to be paid in 2025, 2026, 2027, 2028. So I believe that most of the free cash flow that you see on Guru Focus, maybe you see the free cash flow, will be used to repay the debt. So don't expect a lot of capex. Don't expect a lot of reinvestment opportunities. I think that over the coming years, most of the free cash flow will be used to repay the debt. And they can renew the debt, but this may be the case. The guidance for 2024, well, 2024 is over. FX rate. What is that? No impact on our business. That's a very interesting business. If somebody is interested in infrastructure in Africa, in Nigeria, this is very promising. Nigeria maybe is the most populous country in Africa. Let me check. Yeah, you have a lot of people in Nigeria. You have 200 million people? Nigeria population, 200 million people. That's a lot of people. These people need the electricity, need the resources. So if you are located to be the leader in this, that's definitely interesting. But I have no experience in this sector, to be honest. I don't know if these kind of infrastructure plays are good investments. I know that this will definitely help the inhabitants over there, but financially speaking, investment-wise, is this a good investment? I know no other companies that work in Africa like they do. So very interesting. Definitely not for me. And again, this is 30% of your portfolio. You need a lot of convictions in your two picks. And the third one of your portfolio, Alibaba, will be way easier to analyze. I used to own Alibaba. I've been a shareholder since 2018 and sold the position recently. And my opinion has changed about the company. Before, I believed in the management because they were quite good, quite competent. And now the more I see the situation, the less I like the management. Seems like this has become a big conglomerate, a big, slow-moving company that is very stable and struggling. The margins are dropping, and the only thing that is good about investing in Alibaba is the dividends and the buybacks. So now if you look at Alibaba, you will see what I'm talking about. You are talking about a cheap business, but the business is cheap for a reason. If you look at the metrics, if you look at the PE ratio of the business, you are talking about a PE ratio of, they show 20, but it's more around 10. You have to account for some stuff. The PE ratio is between 10 and 20. They have a lot of cash. If you remove, do you have enterprise value here? No, I don't have it. Too bad. They have a lot of cash in the balance sheet. A lot of cash in the balance sheet. If you remove the cash from the balance sheet, you have the enterprise value. And if you check the free cash flow to the enterprise value, you have a company that is trading extremely cheaply. But this is a company with low margins. Can I check the margins over time? Metrics. These are our metrics. These are our margins over time. You are talking about a decaying business that is struggling to become profitable again. The margins are going south, and all the earnings, all the free cash flows are given to shareholders as buybacks. If you look at the free cash flow here, you look at the buybacks. Buybacks are growing. That's nice. I love to see it. Same thing for dividends. Now they have a 4% dividend yield. Let me check on Baba. You have that's basically it. Now Alibaba just released a new AI that is expected to grow nicely, but I don't really buy it. You have a forward PE ratio of 10. You have a price to free cash flow of 11 as of 2024. So for 2025, you have a price to free cash flow below 10. You have a stable business with a lot of cash, and they repurchase 5% of their outstanding shares every year. So 5%. And additionally, they have a 1% dividend yield. So 5% plus 1%, you have a 6% shareholder yield on the business. And you have this potential of growing again. But I'm not really convinced. This is maybe the reason why I recently sold the business. So I'm biased, obviously. I don't buy into the guidance of management because I've been listening to management for years. As I told you, I bought my first shares of Alibaba here at $208. So in 2018, and I've been following very, very closely what they do. And I don't believe this is one attractive risk reward. I think you have better opportunities in China. So interesting pick, but I'm not part of the family anymore. So, but I see what you see on Alibaba. I wish you the best. I just sold my shares, so now it can double. Let me continue. Evolution. You own some Evolution. That's 13% of your portfolio. Obviously, I will be biased, but the other way around. I think Evolution is one of the best risk reward opportunity you have in the market right now. The stock has been going nowhere for 4 years, but the financials have been improving for 4 years and even more. And the company is starting a new buyback program, new dividends. You have a 4% dividend yield, a 3% buyback yield. So that's a 7%, 4 plus 3, that's 7% shareholder yield for a company with a PE ratio of 12. Seems good to me for a very high margin business. In case you don't know Evolution, they do games for online casinos. They have a net margin of 60%. Life is good. They make a lot of money. They are the leader. They are with a 60-70% market share, growing nicely in regulated markets now. So you have a lot of worries. All the risks are on the operating table, and the management seems to know what they are doing. So all the risks are here. The stock is priced as if this business would not grow anymore. But even now, with all the risks, the business is growing revenue 10-12%. Fine, good to me. Way better than Alibaba. So you have no debt whatsoever, a lot of cash for an efficient business model. This is 10% of my portfolio. So again, take what I say with a pinch of salt. I'm biased. This is 10% of my portfolio. And I think it will do great things in the future. Maybe we will be wrong, but it's worth taking the risk. Now, JD.com. JD.com is another business in China that is very cheap. Maybe even cheaper than Alibaba. They have a lot of cash. Similarly, they do buybacks. Similarly, they do dividends. And similarly, they are getting hammered by the market. Similarly, the stock is going nowhere. This is, if you look at the momentum of these Chinese stocks, this is a mess. All the gains for the past 10 years have been evaporated. And I think this is even cheaper than Alibaba. So similarly, JD is in the online e-commerce industry in China, very big. And if you look at the revenue growth has stabilized. The net income is a little bit strange for this company. They have a lot of cash. They do dividends. You have a what? A 2% dividend yield. And what about the buybacks? They don't do buybacks? Come on. Did I? Oh, yeah, they are starting to do buybacks. They bought 2% of their shares in one quarter, 4% of their shares, and now 1%. So you can get like a 4% buyback yield. So you have a 4% buyback yield plus a 2% dividend yield. That's a 6% shareholder yield. A lot of people will be happy with that for a company with a lot of cash, some efficiency. But similarly, China is not in a bad shape at the moment. So you bet on China picking up again. Maybe it's a macro bet at the end of the day. You are talking about a cheap business that is rewarding shareholders. The margins are not high at all, normal. This is an e-commerce business. Forward PE ratio is 9, so definitely cheap. The only worry I would have with these Chinese names is that the Chinese economy doesn't pick up again. Because if you just look at the data, China has been suffering in 2020, 2021, 2022, 2023, 2024. Why not for the next 2 years? Why not continue in this downward trend? Now, as the US is getting more active in the world, China, I don't know if China will be hit or not, but for the moment, I see no signs of rebound for the Chinese economy. Maybe I'm wrong on this one, but I see no sign. It seems like the government doesn't want to put a huge stimulus to the Chinese economy. They did a stimulus of $1.4 trillion a couple of months ago, but that's peanuts. I mean, that's a very small stimulus package. They don't want to have inflation in China. They don't want to have a huge stimulus package. They don't want inflation to go up, interest rates to go up, because they don't want to die. So it's a big country that is very old and that want to keep their leadership. And I think putting a huge stimulus will not help them in the long term. Unfortunately for you, investors in China, the Chinese government will not help you in the short term. So it's quite likely that you will suffer in the short term. I'm telling you, I've been suffering since 2018. So that's it. And I will say something else about China. If you look at the Chinese index, even for the large ones, the FXI iShares China Large Cap ETF, please hold to something big, because you may fall from your share. If I look at the max and the stock price for the ETF of China large cap for the past 20 years, I see absolutely no results. So you may say, yeah, Chris, but maybe this one, it will change. Yeah. Now, at the end of this video, you can check on the internet, on Google, you type Hang Seng earnings per share or China earnings per share over time. And you will see that the earnings per share of Chinese companies have not improved for the past 20 years. And at the end of the day, stock prices follow earnings per share. So if the earnings per share of these companies don't grow, the stock prices will not grow eventually in the long term. So I've come to the conclusion that at the end of the day, what matters in the stock market is earnings per share, free cash flow per share. If you don't grow your earnings per share, your stock price will not grow. And for China, the earnings don't grow because of very fierce competition, government intervention, all the reasons, macro, whatever you want. At the end of the day, you need to be highly profitable, growing your earnings per share. And I would be worried if I was invested mostly in China, because that's a lot of stress. And that's also why I sold the position. I was not comfortable investing in China for this reason. If I believed in a reversion to the mean, that never happened. And that's my opinion. Maybe I'm completely wrong. You have another opinion because you are invested in China at the end of the day. So yeah, JD, same scenario as Alibaba. Buyback, dividends, cheap, growth, no growth, stable company, and you bet on the Chinese rebound. Next, 3323. Oh, this is like 333. Yeah, this one, 3333. That's Evergrande. I will not like what I see. I know I will hate these picks. I've been following the Evergrande collapse. China national rebuild. China national rebuild. Wait. Building. Can I see it? China national building. Okay, that's this one. What is the market cap of China National Building Material? Market cap is this one. What is the equivalent in dollars? In dollars, come on. Come on. Well. What's the ticker? Well, sorry, this is live. The market cap for this company is, it should be small because these stocks have been destroyed. $4 billion for maybe one of the national building companies in China. So yeah, if you look at the revenue, I mean, this will be horrible. This will, I don't even want to look. If you look at these, the financials and the mess that is the Chinese economy at the moment, if you look at real estate, that's horrible. I've been following the downfall of Evergrande for years now, and it seems like Guru Focus is bugging. You have a lot of dividends. You will have my conclusion before the financials. It's a lot of risks to invest in Chinese real estate at the moment. The stock has been completely destroyed. Market cap of $4 billion. The debt amount for these home building companies in China is huge. Like for all the real estate companies, that's normal, but you have an additional risk because it's in China. The net income for this company has dropped significantly. The free cash flow for this company has dropped significantly. They have a lot of debt to repay. And I believe most of the free cash flow the company will be used to repay the debt. So definitely, no, I mean, I would never invest in this company regardless of the price. If you offer this company for $1, I will never not touch it. It's not worth the stress, in my opinion. It's a tricky business. It's a lot of suffering. And if you want to bet on the Chinese rebound, you have other opportunities. I mean, you already have JD.com, you have PDD, you have other Chinese names that are way better. Evergrande has been show lately. A lot of losses, a lot of lies, a lot of financial accounting, but not a lot of free cash flow, not a lot of earnings, definitely not a lot of cash. They have a lot of debt. It's a lot of suffering. I would love to have your opinion why you invested in these two businesses. But that's interesting. I mean, that's a small part of your portfolio, so it won't kill you if these businesses go bankrupt for some reason. But I don't think you will have a government bailout the same way you had with the US, for example, in 2008. The Chinese government doesn't have the same mindset when it comes to bailouts. So we will see. Wait and see. But after all, I'm not Chinese. I'm just a French guy. So what do I know about the Chinese economy? Anyway, I will not invest in these stocks in China. And I mean, Basic Fit, very interesting. Nigeria infrastructure, very interesting. Alibaba and JD, definitely that's a bet in China. And for evolution, I'm very bullish. So yeah, that's a very interesting portfolio. You don't see these picks often. So congrats. You need a lot of courage to have this strong conviction. I mean, 30% in basic fit, that's a lot. So wish you the best. I hope this video has helped you and raised some questions when it comes to the financial statements. And that's it. Thank you for sharing your portfolio. I wish you a nice rest of your day.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.